From Central Indiana's #1 news source, this is Fox 59 Tonight.
Welcome back to Fox 59 Tonight. I'm Cameron Riddle. We continue the show now talking about money. It's Friday, so we got to talk financials here on Fox, and our financial expert Kordel Drake is back here in studio. Kordel, last time we talked about credit. This time we're talking not just about credit, but also loans, which also affect your credit. But loans is something that come in handy, but they're not fun when they have to be paid back. And they do have to be paid back. So the question for you, what is when someone first says, I'm thinking about taking out a loan, the first words out of your mouth would be what?
Take your time, make sure that this is something that you have to have, and make sure that it is worth it. There are certain things you have to take a loan out on, the majority of the public, i.e., a home, a car. But you shouldn't be taking a loan out for smaller ticket items, clothing, furniture, things of that nature, unless they are going to allow you to do it interest free. You have a certain amount of time to pay it off interest free. But uh, ideally, with a loan, you want it to be big ticket items. Like I said, a house, a car. I guess furniture, depending on, if you're furnishing the whole house, that would make sense. But
Mm-hmm.
you want to try to make the principal amount with those type of loans as small as possible,
Mm-hmm.
because that's the key. The larger the principal, the larger the interest rate, the more you're going to pay.
All right. So when we're talking loans, it's not just a company giving you money. Their purpose of giving it to you is so that they can make some money back off of you, right?
Exactly. Anytime you want to find out the purpose of a business, just look at their website. If it says .com, they are in the business of making money. If it says .gov or .org, that is not their primary purpose. But if it is .com, rest assured their goal is to make as much profit as possible.
So that is that you can take out a loan for $25,000, and they say if you pay this off on time, um, you'll end up paying back a total of 30,000. That's that interest. That's the profit they made off of doing you a favor by loaning you some money.
Exactly. Yeah, the company has decided, okay, we've run Cameron's credit. He's a good credit risk. We will charge him a certain amount of money to loan him this money because we think he's good to pay it back. The better, as we spoke about previously, the higher your credit score, the better your interest rate.
Mm-hmm.
The lower the interest rate, the less you pay back. So
Now, then the other part with that is the loan itself does affect your credit score.
it does. It does. Anytime you someone says, hey, I need to run your credit, that lowers your credit score. So you want to be careful and not do that haphazardly, constantly applying for certain things. Because one or two things are happening. Either you are running your credit and you're a good credit risk, you'll get that loan and move on. Or if you keep doing that over and over, it's because you're being denied
Mm-hmm.
or you're taking out too much. You're over leveraged. It's not about how much you make, it's about how much you spend in relation to how much you make.
Mm-hmm. But explain that. Say that phrase again and explain that.
Well, it's not how much you make, it's how much you spend uh, out of how much you make. For instance, we've seen the horror stories of millionaires going broke, which seems unfathomable to the average person. It's like, how could you have $100 million and end up broke.
Mhm.
But if you have 100 million and you spend 150, you're
Mhm.
going to be broke. So once again, it's not how much you make, it's how much you spend out of how much you make. So it is called a earnings income to earnings ratio.
Mhm.
And so I think we spoke about that last week, but you want that to be about 30% or less, meaning for every dollar that you make, you're only spending 30 cents of it.
Mhm. Mhm. So now the loan, like we said, is meant to be paid off, but the loan companies uh, don't want that money back too fast. Why is that?
Well, the longer you have that loan out, the more you're going to pay. And that is guaranteed income for them. That's an income stream. So on their books, they see Cam owes us $20,000 and it's going to take him 10 years to pay it off because he's making a minimum payment. We can count on that. That's income.
Mm-hmm.
So you add that up over hundreds of thousands of millions of customers, that's a lot of money.
Mm-hmm.
They aren't opposed to you paying it off early because ultimately they want their money back. But the longer you take, the better off it is for them because they're making more. But if they give you 20,000 and you pay it off early and only pay them 22,000
Mm-hmm.
back, they still made a nice profit
Correct.
and they made it in a short amount of time. And
Mm-hmm.
now they're ready to move on to the next person. And you'll probably, chances are, you'll come back again.
And that's why. So there are two phrases: penalties, and then they give you a discount. So I know of some loans that if you pay it off early, but not too early, you know, if it's, let's say you got 5 months and you pay it off in 3 months, they'll shave off 2,000 of what they were going to profit. But then explain what a penalty is, because that's usually a question people ask: is there a penalty if I pay this off early?
Well, that would be where the company has specified, even if you pay it off, bless you, even if you pay it off early, there is a penalty for paying it off early. It's not a common practice, but it does happen. And that's where you have to take your time, do your due diligence, and read the paperwork before you sign on the dotted line. Make sure you understand everything. Ask all the questions that you have so you're clear on what you're getting into. You know, I'm a big proponent of people being informed. Make an informed, intelligent decision. Take your time. It's your decision. Don't let them rush you into it. And that's why, you should try to have money set aside for emergencies because life happens.
Mm-hmm.
And you don't want to be rushed into something, i.e., your refrigerator goes out. You can't function without a refrigerator. You have to get one. Well, if you don't have any money set aside, you've got to go out and take a loan out or put it on this credit card, God forbid, and you know it's going to take you a long time. That $1,000 refrigerator, because you had to have it right then and you didn't
Mm-hmm.
have any resources to take care of it, that's could easily turn into a $1,500 refrigerator.
And that's, of course, that's the moral of always wanting to keep a little savings in case of an emergency. I know because the air conditioner just went out. So,
Yeah, yeah,
dealing.
we discussed that earlier. It's countercultural, but live below your means.
Mhm.
Humble yourself and live below your means. Humility is a wonderful trait. Humble yourself.
Now, loans, paying it off quickly. Does that now again? And the difference is, before I was asking about um, the credit, the loan company may not want you to pay it off too early, but how does that affect your credit score if you're paying it off quickly?
If you pay it off quickly, it doesn't hurt because one of the things that the credit people look at, for instance, FICO, they look at how much credit you have available against how much you're actually using. So
Mm-hmm.
you got, say, $10,000 worth of credit available.
Mm-hmm.
If you're using 7 of that, that doesn't look good.
Mm-hmm.
You're what they call leveraged. You're
Mm-hmm.
leveraged pretty high. Well, if you've got $10,000 worth of credit and you only have $500 outstanding,
Mm-hmm.
that's good.
Mm-hmm.
It shows discipline. It shows character. Like we can trust you with money. Just because you have it doesn't mean
Mm-hmm.
you have to spend it.
Mm-hmm.
And so paying it off early is a good thing. Anytime you can reduce that principal and pay something off, it is a win-win for you. Your credit score looks better. Your debt has
Mm-hmm.
gone down, and you look like a reliable, responsible adult.
We actually had we had a financial advisor actually on earlier this week, and we were talking some about credit cards, and uh, we were talking about that balance. We would not only paying that minimum balance um, each time, but that's where the credit card companies make money off of you because you're paying that minimum balance. But there was something else that you said that kind of echoed what she said, um, and it'll come back to me. But it was something about it's something in there about keeping that balance low. Um, it'll come back to me. You
That's
said it when you
okay.
talked.
Yeah, it's okay. Yeah, like I said, the goal is to reduce the principal. Last week you asked about making extra payments,
Mm-hmm.
and it's actually a good thing. It's something that I would encourage all homeowners to do with their mortgage. If you speak with your mortgage company and say, I want to make my payment bi-monthly,
Mm-hmm.
if you do that and they agree to it and get it set up, you will make an extra payment each year.
Mm-hmm.
Over the course of your loan, you will reduce the amount of years that you pay significantly.
Mm-hmm.
They'll run the numbers for you.
Mm-hmm.
They'll run a mortgage table for you and tell you, instead of paying $1,000 a month, if you pay 500 every 2 weeks,
Mm-hmm.
you'll reduce your loan amount.
Wait a minute. What now? Say again. That's the
So
same amount of money.
same
500.
amount, 500. But if you think about it, 500 every 2 weeks. There are 52 weeks in a year.
Mm-hmm.
Okay. If you make 2 payments a month,
Mm-hmm.
all right, that's 26 payments.
Mm-hmm.
Okay. That's 13 months that you're covering.
Mm-hmm.
You're making 13 months worth of coverage in payments versus 12.
Mm-hmm.
So because of paying every 2 weeks, and it works real well if you get paid every 2 weeks. Just set it up with your mortgage company to pay your mortgage every 2 weeks. Now, like I said, you have to do your research, you have to do your work, call
Mm-hmm.
them, say, do you have bi-monthly payments
Mm-hmm.
scheduled?
Mm-hmm.
Most of them do.
And that's just taking, and the reason you have to set it up is because that is just taking your current mortgage. Not saying I want to pay twice as much a month, but I want to pay
That's
this
this amount
twice a
twice,
month.
right? So your mortgage is due the first of the month,
Mm-hmm.
$1,000. Well, you tell them I will give you 500 on the 15th and 500 on the first. Now, on the first, you have your $1,000. But you have to get ahead of the curve,
Mm-hmm.
when you do that. And they'll explain to you how to set it up and how to do it. It doesn't require any refinancing, doesn't require anything. It's just how they set your mortgage up. And a lot of companies do it. Ask them. All they can say is, no, we don't do that. But it would be a huge benefit because if you think about it, each year you're making an extra payment.
Mm-hmm.
So after 10 years,
Mm-hmm.
you've made 10 extra payments, almost
Another year.
another year. But because of the effect of the interest,
Mm-hmm.
it's a lot more effective.
Mm-hmm.
And they have what's called a mortgage table. Take your time, crunch the numbers, and look, and you'll save a significant amount of money. And you haven't spent any extra money. It's just a strategy.
I've never heard
That's why I'm here, Ken.
that.
That's why I'm here. Just giving information out.
So, because I'm thinking about my mortgage now, it's $2,000 a month ish, a little under. escrow, all that.
right?
So if I just wanted to pay $1,000,
Every 2 weeks.
that would knock off. I'm still gonna be paying it for a long
Yeah,
time.
you're still gonna be paying, but it would
This,
be and I'm just ballparking it. I don't have the figures in
mm-hmm,
front of me because I don't have the mortgage in front of me, but they will run that mortgage table for you. Say you have 28 years left on your mortgage.
mm-hmm,
You start doing that, you may pay it off in 22 years. You may
mm-hmm,
save yourself 6 years,
mm-hmm.
and you've not paid any extra money. It's just how you attack the loan. You know the old saying, "How do you eat an elephant? One bite at a time." Well, it's 2 bites at a time.
Well, okay, so then I think this is where I was going with the credit card question from earlier.
Sure.
When you're paying it off, is there a tactic like that? Do you attack one credit card at a time? If you got multiple and you want to pay them down, do you attack one at a time or do you spread that out? How do you keep that minimum payment low, but you still want to be able to use it, but you want to pay it off quickly? So how do you attack it?
You attack the highest interest rate. Find the one that has the highest rate. That's the one you want to eliminate first.
Mm-hmm.
Think of it as you're fighting multiple people.
Mm-hmm.
You want to get the one with the big mouth, the bully. You
Yeah.
want to knock the bully out 1st,
Mm-hmm.
and then move to the next one doing all
Mm-hmm.
the talking and just work your way through it.
Don't necessarily start with the one that has the highest balance, because if they're charging you 1%, but another credit card is charging you 27%, but it's got a lower, it can quickly become the highest one.
Exactly. You want to do it by rate, unless they're real close. I mean,
Mm-hmm.
17 and 18, you got a $10,000 18% and a $30,000 17%. Then obviously, yeah, you want to attack the larger loan, but you typically start with the largest rate. You want to attack that first, and the key is you have to have discipline. I
Mm-hmm.
mean, at the end of the day, you have to humble yourself and have discipline, and just decide: is this something I want, or is this something I need?
Mm-hmm.
And a lot of times, our wants and these impulse purchases get us in trouble.
Now, is when you're paying that off, because I'm listening to you, knocking down that interest. The years don't really bother me because I mean, yeah, that's cool, but that's still 26 or 28 years from now, still a long time. But I'm hearing about the interest and the money that I'd be saving. But what does that do to your credit score? Does that help at all if you were paying it twice a month?
Yeah, it doesn't hurt it. It
Doesn't
doesn't
hurt it.
hurt it. It has a negligible effect because at the end of the day, you're still paying on time.
Mm-hmm.
It doesn't hurt or help. It's neutral. It's like empty calories,
Mm-hmm.
but it helps you in the long
Mm-hmm.
run.
Mm-hmm.
It helps you. Here's another thing with that same mortgage. There's something on most mortgages called PMI.
Okay.
That's you're paying for insurance just in case you default.
Mm-hmm.
That PMI can come off typically when you have 20% equity
Mm-hmm.
in the home, i.e., your house is worth 100,000, you own 20,000 of it. You only have an $80,000 mortgage. When you get that, you can petition the mortgage company. Hey, take that off. I'm good for this.
Because you've proved I can pay.
Right, I can pay, and I have skin in the game. I'm not going to default.
Mm-hmm.
I'm not going to leave 20%
Mm-hmm.
hanging in the wind. And you can eliminate that as well. That also lowers your payment, and you can take that and just roll it into the payment.
Mm-hmm.
If you're comfortable with it, you've been paying it. Now you're just paying more towards the principal.
Mm-hmm.
You're just reducing the principal. Your payment hasn't changed.
Mm-hmm.
You're still paying,
Mm-hmm.
in this example, $500 every 2 weeks. But now, out of that 500, more of it's going towards, maybe instead of $270 going towards principal,
Mm-hmm.
now $320 every
Mm-hmm.
2 weeks is going towards principal.
So suppose you add. Let me ask you about refinancing, if I can.
Sure.
We explain when you want to do that in the economy when interest rates are low. If you got, I guess, Interest rates are usually low when the economy is what? Good or bad?
Interest rates are low when the economy is not doing well. It's a
Right.
way to jumpstart the economy. So if you think about it this way, are you more likely to buy a car if interest rates are at 9% or at 2%?
2%.
Exactly. It's incenting people. Are
Mm-hmm.
you more likely to buy a house if interest rates are at 7% or 2%?
But the economy is bad. So to get me to buy something, you got to drop the interest rate.
You right. You got to give you incentive.
Right.
You give the incentive, more people are participating in the economy, revving it up.
And so now, hang on before you lose me.
Sure.
So this is where we get into the discussion about the economy and the politics that is used against people, because if people look at it and say interest rates are too high, well, that means the economy is good. That means people are spending.
Right.
And
And
so
you want to slow it down.
but if my goal is to make money, I don't want a lower interest rate. If I'm selling,
Right.
I want those interest rates up.
Right. Because you are charging people more to borrow.
Correct.
If from the business side, it's good for you, higher interest rates. But it's like a balance. Also, though, when interest rates are low, your money that's sitting in the bank
Mm-hmm.
doesn't do anything for you. It's making 0.1%. You're more likely to be like, well, I'm gonna go spend this instead of leaving here saving, not doing anything. Let me go spend this. So it all works together to motivate people to get money into the economy and take it off the sidelines.
So isn't that though? So when the economy, I'm thinking politics. I'm thinking presidential elections, and people, that I guess that's how there's a disconnect when people say, how could the economy be so great if housing prices are so high and interest rates are so high?
Honestly, there should be, and it is designed to be, a separation of the executive branch of the government and the economy. They're
Mm-hmm.
supposed to be separate
Mm-hmm.
because politics shouldn't dictate it.
Mm-hmm.
You should just do the balancing of the economy to
Mm-hmm.
do what's best for the American people. And if we're in a recession and nobody's spending and businesses are slowing down, then the Federal Reserve should lower the rates to incent people to do business to pick it back up.
But that is, um, but now it's starting to make sense. The story that gets told when the economy is not good, you can pick something to the person who doesn't understand and say, "Look how low interest rates are. Look what I did." That, and then people think that when the economy is bad because things are cheaper, that things are good. No, it's supply and demand.
Exactly. Exactly. Yeah. The thing is you have to be an informed consumer. That's kind of why I'm sitting here. I just want to get I'm not giving advice. I'm just giving people information. It's the old adage, somebody tells you, "Hey, we're having a fruit. I want you to bring a fruit salad." And you show up with a bunch of tomatoes and you're like, "Yeah, you said a fruit salad. Tomato is a fruit. Yeah, technically it is a fruit,
Mm-hmm.
but that doesn't make any sense."
Mm-hmm.
You have to use the information appropriately.
And so that's why, and the example that I use is gas prices. When it's election time, the if I was president, and I thought about this not being president, but if I was president, how I would explain this to people. We always blame the president when gas prices are high, and we want to. Every president says we're going to lower gas prices, but if you take supply and demand as president, I would look into the camera and say, "Look, people, if gas prices are high, that means you have money in your pocket. That means the economy is good. You have money to spend. You want gas prices, as that is not a bad sign. It is a good sign. That means you have money in your pocket because the gas company knows this, so they're going to take it from you."
Exactly. Yeah, it's supply and demand. Think about COVID.
Mm-hmm.
Nobody's driving. Everybody's restricted. Unless you were an essential worker, you were
Mm-hmm.
told to stay home.
Mm-hmm.
That means there's no demand for gas.
Mm-hmm.
So what did they do? Gas prices were
Went down.
$1.70. I mean,
Mm-hmm.
just historically low.
Mm-hmm.
People like, well, I don't have any place to go, but I'm going to buy some gas
Mm-hmm.
because it's low.
Mm-hmm.
Supply was too high. So they had to lower the prices to bring the demand up.
Mm-hmm.
And so you have to take a holistic view of things. Because interest rates are low,
Mm-hmm.
the economy is going real good, you've got to raise them up to slow it down. I mean,
Mm-hmm.
anything overheated, it's going to have a problem at some point.
So in short, gas prices are low. It's usually not a good time.
Typically, it's
You could
not.
you could probably correlate bad times with low gas prices.
Typically, but there are other factors, and I'm not really a energy expert, but
Mm-hmm.
there's also uh, who's making the oil,
Mm-hmm.
where's the oil going,
Where's it coming from?
where's it coming from?
Mm-hmm.
So for some reason, I don't know, I haven't understood it. The U.S. has a lot of oil
Mm-hmm.
supply
Mm-hmm.
available.
Mm-hmm.
They rather import it for whatever the reason. I don't know. It's above my head. I think it'll be interesting though to see as you use gas prices as we get more EV vehicles.
Mm-hmm.
There's less demand for
Mm-hmm.
gas to see
Mm-hmm.
how that'll affect it as well. Some of these things are upon discovery.
We learned a lot. We learned a lot here. Okay, remember gas prices down. If you're president, tell people that that's not good. Gas
Not
prices up,
necessarily.
not necessarily.
Not it could be good.
All
It
right.
just depends why the gas prices is down.
Well, my point is, it doesn't always mean that if gas prices are too high, it does not mean things are bad.
Doesn't mean things are bad, but they probably should be more reasonable. You have to understand from the point of view of, say, a single mom.
Mm-hmm.
She's got to drive certain places. If a tank of gas costs her $25
Mm-hmm.
a week, now it's gone up to 55 over the course of a month and 2 months.
Mm-hmm.
That single mom on a tight budget,
Mm-hmm.
that's huge.
Yeah.
That's huge.
Yeah.
So you can't. I guess I wouldn't use a blanket statement.
Okay.
I wouldn't necessarily say high gas prices are a good thing,
Mm-hmm.
and I wouldn't say it's not necessarily a bad thing. It
Mm-hmm.
just depends on the situation. Why are they high? Like for instance, gas prices being high because Putin decides to invade the Ukraine, and
Mm-hmm.
people wondering about oil, and oil prices are sky high. That's not good.
Right. I would say, having said that, I'll reframe my argument and say, I would start making the argument if I was president that does not mean it's a bad thing. Just like you said, it may not be a good thing. I could make an argument that doesn't mean failure or that things are bad. All right, Kordel, we're out of time. We will talk with you next week with more financial facts here on a Fox Friday. Thank you, sir.
Yes, sir. You're welcome. Have
All
a
right,
great day.
that's going to do it for this edition of Fox 59 tonight. I will be back tonight with more news. I'm anchoring the 10 o'clock news here on Fox 59 now, so we will see you then. And then we'll talk to you Sunday on my radio show, Open Lines. That is 8 a.m. on WTLC. Have a good night.
All right, sister.